In the world of investing, there's a phrase you've likely heard, a piece of wisdom so often repeated it's become a cliché. It comes from Warren Buffett, and it's the advice to stay within your circle of competence. It sounds simple. It sounds like a call for caution, for humility. It sounds like a rule designed to keep you safe. And it is. But that interpretation, the simple, safe, and static one, is dangerously incomplete. It's the public lesson, the one taught in business schools and quoted in financial news. But it is not the secret. It is not the engine that has driven 50 years of unparalleled success. The true principle, the one that separates Buffett from 1,000 other cautious money managers, isn't just about having a circle. It's about the lifelong, disciplined, and relentless mission to make that circle bigger. It's a process of continuous learning, a masterclass in intellectual curiosity that allows for portfolio development on a scale few can imagine. It is the core of his real investment strategy. This is not a story about staying put. This is a story about intelligent expansion. It's about how to get smarter, not just as an investor, but as a thinker and a decision maker. It's the blueprint for how to grow your knowledge without taking foolish risks, how to build upon what you already know to unlock new empires of opportunity. Most investors fail for one of two reasons. They either suffer from a reckless style drift, chasing fads and technologies they don't understand, lighting their capital on fire in the process, or they stagnate, clinging to a shrinking area of expertise, becoming a fossil as the world moves on, missing out on entire decades of innovation and growth. The path we will explore today is the antidote to both failures. It is the methodology for building a fortress of knowledge, and then, brick by brick, expanding its walls. This is the hidden half of the circle of competence. This is the story of how you go from being a competent investor to an evolving, adapting, and truly formidable one. This is the promise of long-term success. The first step on this journey, the absolute, non-negotiable foundation upon which all future growth is built, is the establishment of a fortress. Before you can even think about expansion, you must first define, understand, and defend your initial circle of competence. This is not about limitation, it is about concentration of force. It's about knowing with absolute certainty where your intellectual high ground is, where you have an undeniable edge over the 99% of other market participants. To ignore this first pillar is to build a skyscraper on a swamp. It is a guaranteed recipe for financial disaster. The most powerful lessons in life are often learned not from triumphs, but from scars. And for Warren Buffett, the scar that taught him the brutal importance of this foundational pillar was woven from cotton. It was the painful, multi-decade saga of Berkshire Hathaway itself, the textile mill that would give his legendary holding company its name and its most bitter lesson. In 1962, Warren Buffett was a young, brilliant practitioner of what's known as cigar butt investing, a strategy taught to him by his mentor, Benjamin Graham. The idea was simple. Find a company trading for so little that it was like finding a discarded cigar on the street with one good puff left in it. You'd buy the company for less than its liquidation value, the cash, inventory, and equipment it owned. And when the business was eventually sold off or liquidated, you'd pocket the difference. It was a quantitative game. You didn't need to understand the nuances of the business's long-term competitive dynamics. You just needed to be able to read a balance sheet and calculate what the pieces were worth. This was his circle. He was a master at valuing a collection of assets. And when he looked at Berkshire Hathaway, a struggling textile manufacturer in New Bedford, Massachusetts, he saw a classic cigar butt. The stock was trading at $7.50 a share, but its working capital alone, the value of its inventory and receivables minus its debts, was over $19 a share. It was a statistical bargain. He began buying the stock aggressively. His plan was simple. The company was consistently closing mills and selling off assets. As it did, the management would offer to buy back shares from investors. Buffett intended to simply wait for the next tender offer and sell his shares back to the company for a small, easy profit. An offer came, just as he expected. The CEO, a man named Seabury Stanton, asked Buffett at what price he would be willing to sell his stake. Buffett told him $11.50 per share. Stanton agreed. But when the formal written offer arrived, the price was 11 3/8. It was an eighth of a point short. A tiny difference, a matter of 12.5 cents per share. But to Buffett, it was an act of betrayal. He was furious. And in that moment of anger, he made a decision that would change his life. A decision driven by emotion, not by the cold, hard logic that defined his circle of competence. Instead of selling, he decided to buy more. He went into the open market and bought enough shares to take control of Berkshire Hathaway and fire Seabury Stanton. He had won the battle, he had exacted his revenge, and in doing so he had trapped himself in a catastrophic business. He now owned a textile company. His circle of competence was in valuing assets on a balance sheet. It was not in understanding the brutal economics of the American textile industry in the mid-20th century. He didn't have a deep fluency in labor relations, in capital expenditure cycles for looms that were becoming obsolete the moment they were purchased, or in the overwhelming tide of cheaper competition from overseas. He was the captain of a sinking ship, and he didn't know how to fix the leaks. For the next 20 years, he and his partner Charlie Munger poured money into Berkshire Hathaway's textile operations. They bought better equipment. They tried to improve efficiency. They fought valiantly. But it was like pouring water into sand. The business was a capital furnace, burning through cash that could have been invested in wonderful businesses, all to prop up a terrible one. In a 1985 letter to his shareholders, Buffett finally admitted defeat and closed the last of the textile mills. He calculated that the capital he had sunk into the textile business, if it had been invested in the insurance operations he acquired later, an industry he did not understand, would have been worth billions more. The opportunity cost was staggering. The pain of this failure, the daily grind of trying to manage a business he fundamentally didn't understand, seared a lesson into his soul. Never again would he venture outside his circle of competence, especially not for reasons of ego or emotion. The Berkshire Hathaway textile mill became the cornerstone of his philosophy, a constant, painful reminder that knowing what you don't know is the most critical form of knowledge an investor can possess. It was the mistake that forced him to build the fortress. The psychological quicksand that pulled Buffett into the textile disaster has a name. It's a cognitive bias known as the Dunning-Kruger effect. Coined by psychologists David Dunning and Justin Kruger in 1999, it describes a phenomenon where individuals with low ability in a specific domain tend to dramatically overestimate their competence. In short, they are too ignorant to recognize their own ignorance. This is the single most dangerous trap for an aspiring investor, a behavioral pitfall that the circle of competence is specifically designed to neutralize. In the world of finance, the Dunning-Kruger effect runs rampant. An investor makes a lucky bet on a hot stock. The stock triples. Their brain is flooded with dopamine, the chemical of reward and reinforcement. They don't attribute the success to luck or market mania. They attribute it to their own innate genius. They believe they have the gift. This newfound overconfidence, unearned and untested, is a ticking time bomb. Suddenly, the investor who got lucky on a simple retail stock now believes they can analyze the complex clinical trial data of a biotechnology firm. The person who successfully flipped a house in a rising market now thinks they are qualified to invest in complex commercial real estate-backed securities. They climb to the top of what Dunning and Kruger call Mount Stupid, a peak of high confidence utterly unsupported by low competence. From this precarious vantage point, the entire world of investing looks simple. They scoff at Buffett's discipline. Why limit yourself? Why not get in on crypto, on SPACs, on cutting-edge software companies? They see his caution not as wisdom, but as a weakness, a relic of a bygone era. They mistake their ignorance for insight. The circle of competence is a psychological defense mechanism against precisely this form of self-deception. It is a pre-commitment to intellectual honesty. By forcing yourself to define what you know, You are, by extension, forced to draw a line around the vast ocean of what you do not know. It is a tool for self-awareness. A true circle of competence isn't built on ego. It's built on a foundation of humility, on the acknowledgement that the world is infinitely complex and that true expertise in any given field is hard-won through years of focused effort and study. The Dunning-Kruger effect explains why so many market participants get wiped out. They venture into hostile territory without a map, without supplies, and without any understanding of the terrain. They buy a company based on a story they heard on television, without ever reading its annual report. They invest in a financial product whose structure they cannot explain. They are operating on pure, unadulterated confidence, and the market, in its cold, impersonal way, eventually presents them with a brutal test. When the test comes, a market downturn, an unexpected piece of negative news, a shift in the competitive landscape, they have no foundation to stand on. Their confidence evaporates, replaced by panic. Because their conviction was never based on deep knowledge, they have no way to evaluate the new information. Is this a temporary setback or a permanent impairment of the business? They don't know. So they sell, usually at the worst possible moment, locking in their losses. The circle of competence, then, is more than just an investment rule. It's a cerebral governor. It's a mental barrier that prevents the initial thrill of a lucky win from metastasizing into the kind of hubris that leads to ruin. It keeps you grounded in the reality of your own knowledge, not the fantasy of your own genius. It is the voice of reason that whispers, just because you were right once for a lucky reason doesn't mean you understand the game. It is the humble admission that the first and most important victory in investing is the victory over your own flawed psychology. So how do you translate this cautionary principle into a practical, usable tool? How do you move from the abstract idea of a circle of competence to a concrete definition of your own personal fortress? The process requires a rigorous and honest self-appraisal. It requires a mental model we can call the 3 Whys test. This is a granular step-by-step blueprint for mapping the actual boundaries of your expertise, separating true knowledge from vague familiarity. First, you must choose a candidate. Pick a company you currently own in your portfolio or one you are seriously considering investing in. This will be the subject of your interrogation. The goal is not to confirm that you're right, but to stress test the very foundation of your belief. Step 1 of the test is to ask the first, most fundamental why. On a clean sheet of paper or a new document, write down the answer to this question. Why will this company be earning significantly more money 10 years from now than it is today? This question immediately cuts through the noise of short-term market fluctuations. It forces you to think like a business owner, not a stock speculator. Your answer cannot be because the stock price will go up. It must be a clear, business-focused thesis. Perhaps it's because they have a powerful brand that allows them to raise prices without losing customers. Or because they have a technological advantage that lowers their production costs far below their competitors. Or because they operate in a growing market and are systematically taking market share. Be specific. Write down every reason you can think of. Step 2 is to apply the second why to every single answer you just wrote down. For each reason you must now ask, why is that true? This is where vague assertions fall apart. If you wrote, they have a powerful brand, your second why demands proof. Why is their brand powerful? The answer must be based on evidence. Because for the last 20 years, they have maintained a 40% market share while consistently charging a 15% price premium over their nearest competitor, and their internal customer surveys show a 95% repurchase intent. If you wrote, they are taking market share, your second why demands data. Why are they taking market share? The answer could be, because their quarterly reports show their revenue growing at 10% per year, while the industry as a whole is only growing at 3%, and their top 3 competitors have all reported flat or declining sales. You are moving from a claim to the evidence that supports the claim. Step 3 is the final and most challenging layer, the third why. For every piece of evidence you just listed, You must now ask the brutal question, why can I trust this evidence? This layer is about interrogating your sources and your own understanding of the data. If your evidence was the company's reported revenue growth, your third why might be, can I trust these financial statements? This leads you to questions about their accounting practices. Do they use aggressive revenue recognition? Have they had any restatements in the past? Who is their auditor? Is it a reputable firm? If your evidence was a technological advantage, your third why would be, why is this advantage sustainable? Can it be easily copied by a competitor? Is it protected by patents? How much must the company spend on research and development each year just to maintain this edge? This final layer forces you to think about the durability of your thesis. After you have run a company through this three-level interrogation, look at your paper. If you were able to answer all three whys for your core thesis, with specific, hard, quantifiable data and a clear, logical narrative, then that company is very likely inside your circle of competence. But if you find yourself using vague language, citing stock analyst price targets as your evidence, or realizing you don't know the answers to the second or third why, then you have found the boundary of your knowledge. It's not a failure, it's a discovery. You have successfully mapped the wall of your fortress. This model isn't about finding investments that are good, it's about finding investments that are knowable to you. An investment can be a brilliant idea for someone else with a different circle of competence, and a terrible idea for you. The three whys test provides the honest, unvarnished truth about where your personal advantage lies. To truly appreciate the power of this disciplined approach, we must examine its opposite. We must walk the path of the 99%, the road paved with good intentions and littered with financial ruin. This is the path of investing in what you don't understand, a path that reached its most spectacular and catastrophic destination during the dot-com bubble of the late 1990s. Imagine the cultural mania. It was an era where the old rules of business and finance were declared obsolete. A new paradigm had arrived, and its gospel was the internet. Taxi drivers were sharing hot stock tips between fares. Dentists were day trading tech companies in between appointments. The financial news networks were a constant parade of fresh-faced 20-something CEOs promising to revolutionize everything from pet food sales to grocery delivery, all powered by the magic of the World Wide Web. The fatal mistake, the core delusion of this era, was the belief that understanding a catchy story was the same as understanding a business. People weren't investing in companies. They were investing in ticker symbols attached to futuristic narratives. They bought companies like Pets.com, which had a charming sock puppet mascot but was spending hundreds of millions on advertising to sell dog food at a loss. They poured money into Webvan, a company that aimed to deliver groceries to your door, without any grasp of the nightmarish logistics and thin profit margins of the grocery business. They invested in companies with .com in their name that had no revenues, no profits, and in many cases, no viable product. Their investment thesis, if you could call it that, was simply that the stock price would go up because it had been going up. It was pure social contagion, a mass abandonment of the circle of competence. While this national frenzy was unfolding, Warren Buffett was an object of ridicule. He was publicly mocked as a dinosaur, a relic who didn't get it. Fortune magazine ran a cover story in 1999 titled, "Warren Buffett, What's Wrong?" The article suggested his value investing principles were dead, that his refusal to buy these high-flying tech stocks was a sign that he had lost his touch. Buffett's response was simple and unwavering. He admitted, freely and without shame, that he did not understand these businesses. He couldn't predict who the winners and losers would be. He couldn't project their cash flows 10 or 20 years into the future. They were, in short, outside his circle of competence. Therefore, he did nothing. He was willing to accept the short-term pain of looking foolish in order to avoid the long-term certainty of permanent capital loss. And then, in March of 2000, the bubble burst. The Nasdaq index, a proxy for this new economy, began a collapse that would erase nearly 80% of its value over the next 2 years. Companies that were once worth billions went bankrupt. The paper fortunes of the day traders, the taxi drivers, the dentists evaporated. It was a financial massacre. Generations of savings were wiped out in a matter of months. The people who had chased the hot new thing, who had ventured boldly into territory they did not understand, were financially and emotionally devastated. Meanwhile, Warren Buffett, the dinosaur, sat calmly on a mountain of cash, his patiently held investments in companies like Coca-Cola and Gillette chugging along. He hadn't gotten stupider. The world had simply returned to sanity. The path of the 99% is seductive. It promises quick riches and the thrill of being part of the future. But it is a siren song. It lures you away from the safety of your own knowledge and onto the rocks of speculation. The dot-com bust is the ultimate parable of what happens when an entire market abandons the principle of the circle of competence. It is a stark reminder that the pressure to participate in a mania is immense, but the price of admission is often your life savings. The difference between operating inside and outside your circle of competence isn't just a philosophical one. It manifests directly and powerfully on the financial statements of the companies you analyze and in the performance of your own portfolio. The direct financial connection is the stark contrast between anchoring your decisions in tangible value versus floating on the unpredictable currents of intangible hope. When you operate within your circle, you are able to ground your investment thesis in the hard numbers of a business's reality. You can look at a balance sheet and understand the relationship between its assets and its liabilities. You can analyze an income statement and assess the quality and durability of its earnings. Most importantly, you can read a cash flow statement and see the lifeblood of the business, the actual cash it generates, and determine if it's sufficient to fund its growth, pay its debts, and return money to shareholders. An investor who understands the railroad industry, for example, can analyze tangible metrics like revenue per ton mile, operating ratio, and the replacement cost of its track and rolling stock. They can build a valuation based on a predictable stream of cash flows derived from the physical movement of goods. This is an investment anchored to the concrete reality of the economy. This is what it means to be a value investor. Conversely, when you step outside your circle, you are forced to abandon these anchors. How do you value a biotech company with no approved drugs? You can't use a price-to-earnings ratio because there are no earnings. You can't use a discounted cash flow model because there is no cash flow. You are forced to rely on a narrative, a story about the potential market size for a drug that might one day be approved. You are valuing the hope of future success, not the reality of current business operations. This directly impacts your portfolio. A portfolio built on companies understood through the 3 Whys test is a portfolio built on a foundation of economic reality. It will have a defensible, intrinsic value. While its market price will fluctuate, its underlying value provides a gravitational pull. This leads to lower volatility and, most critically, a significantly lower risk of permanent capital loss. A portfolio built by chasing narratives outside your circle is a portfolio of lottery tickets. Its value is tied not to business performance, but to shifting market sentiment. It is susceptible to wild swings based on news headlines, analyst upgrades or downgrades, and social media hype. When sentiment turns, as it inevitably does, there is no floor of intrinsic value to stop the fall. The financial consequence is a portfolio characterized by extreme volatility and a high probability of catastrophic loss. On a balance sheet, the difference is clear. Inside your circle, you focus on companies with strong balance sheets, manageable debt, and a history of generating free cash flow. Outside your circle, you often end up with companies that are burning cash, have mountains of debt, and whose primary asset is an unproven idea listed as goodwill or intangible assets on the balance sheet. The first is a fortress of financial strength. The second is a house of cards. The ultimate financial advantage, therefore, of rigorously defining and defending your initial circle is risk management. It is the mechanism that ensures your long-term financial journey is one of personal growth and knowledge compounding, not a series of gut-wrenching gambles that threaten to send you back to square one. Once the fortress is built, once its walls are defined and its foundations are secure, the great work can begin. The common misinterpretation of the circle of competence ends here, with the investor safely locked inside their castle, defending against the unknown. But Buffett's true genius lies in the next phase, the disciplined, methodical process of expansion. This is not about randomly charging into new territory. It is about a calculated series of reconnaissance missions. It is the art of adjacent exploration, using your existing knowledge as a base camp from which to safely and intelligently survey the surrounding landscape. It's about realizing that every area of expertise is connected to others, and by following those connections you can slowly and surely widen your map of the world. The story of how Buffett moved from the statistical certainty of balance sheets to appreciating the intangible power of a great brand is a perfect illustration of this second pillar in action. In the early 1960s, one of Buffett's largest investments was in American Express. This investment was perfectly within his then-current circle. He wasn't betting on its growth prospects or its brand. He was betting on a market misunderstanding. A scandal had erupted. A division of American Express had been issuing warehouse receipts for vast quantities of salad oil held in tanks in New Jersey. It turned out the tanks were mostly filled with seawater. The company that borrowed against the oil, Allied Crude Vegetable Oil, went bankrupt, and American Express was on the hook for massive losses. The market panicked. Wall Street assumed the scandal would ruin the company's reputation and that its core business, travelers' checks and charge cards, would collapse. The stock price plummeted. But Buffett did his homework. He went to restaurants and banks. He observed customers and talked to merchants. He saw that people weren't abandoning their American Express cards or travelers' checks. The scandal was contained to one obscure division. He realized the company's core asset, the trust its customers placed in that little green card, was unharmed. He also dug into the balance sheet and understood the power of its float, the money from sold travelers' checks that the company could hold and invest before they were cashed. It was a classic Buffett investment, a great business temporarily clouded by a single solvable problem. He invested 40% of his partnership's capital and made a fortune as the stock recovered. This deep dive into American Express taught him something profound. He had bought it for its financial characteristics, but he came away with a deep appreciation for the economic power of a dominant consumer brand. He saw firsthand that the trust people had in the American Express name created a moat around the business that competitors couldn't easily cross. This was a new piece of knowledge, a beachhead in a new territory. It was adjacent to his understanding of insurance float, but it was about psychology, not just finance. This new understanding became the anchor for his next exploration. His partner, Charlie Munger, had been trying for years to get him to move beyond the cigar butt approach and invest in wonderful businesses at fair prices. Munger brought him the opportunity to buy a company called See's Candies. On paper, See's looked expensive. It wasn't a statistical bargain. It was being sold for a price well above its tangible assets. The old Buffett, the pre-American Express Buffett, would have walked away immediately. But now, he had a new lens. He saw See's Candies not as a collection of factories and inventory, but as the owner of a powerful brand that resided in the minds of millions of Californians. For decades, giving a box of See's Candies for Christmas or Valentine's Day was a tradition. Customers were intensely loyal. That loyalty gave See's pricing power. Every year, they could raise the price of their chocolates and people would happily pay it because they weren't just buying chocolate. They were buying nostalgia, quality, and tradition. Buffett realized this pricing power, born from the brand, was an enormous intangible asset that didn't show up on the balance sheet. He was able to connect the psychological moat he had witnessed at American Express to the one that existed at See's Candies. It was an adjacent move, from a world-class financial brand to a world-class consumer brand. In 1972, Berkshire Hathaway bought See's Candies for $25 million. It was a pivotal moment. Since then, See's has generated over $2 billion in pre-tax earnings for Berkshire, capital that was then used to buy other wonderful businesses. The reconnaissance mission was a success. By using his deep knowledge of one company to understand a principle, and then applying that principle to an adjacent industry, Buffett had successfully and safely expanded his circle of competence. The human brain is a pattern-matching machine, but it's also lazy. It defaults to what is easiest to recall. This psychological flaw is described by the availability heuristic, a mental shortcut where we rely on immediate examples that come to mind when evaluating a topic or decision. This is why most investors chase what's hot. The news is filled with stories about artificial intelligence, so they start searching for AI stocks. Their friend tells them about a massive gain they made in a cryptocurrency, and suddenly that's all they can think about. Their information diet is dictated by what the media and their social circle make most available to their mind. This leads to a chaotic and reactive investment process, jumping from one shiny object to the next. Buffett's method of adjacent exploration is a powerful antidote to the availability heuristic. He doesn't start by asking, "What's in the news?" He starts by asking, "What's connected to what I already know and own?" This approach relies on a different, more powerful cognitive principle: anchoring. An anchor is an initial piece of information that we use to make subsequent judgments. For most investors, the anchor is a headline or a hot tip. For Buffett, the anchor is his own meticulously curated portfolio of deeply understood businesses. This anchor provides a structured and logical starting point for all new research. It creates a system for generating investment ideas that are, by their very nature, more likely to be within his grasp. When he owned the Buffalo Evening News, he began to study other newspapers, and then television stations, and then other media properties. He was exploring the media ecosystem. When he owned insurance companies, he was constantly analyzing the financial health of banks and other financial institutions. When he bought a furniture retailer, he began to study carpets, appliances, and other parts of the home goods industry. This process is deliberate, not random. It's a recognition that industries are not isolated islands. They are interconnected webs of suppliers, customers, and competitors. By using your current holdings as the anchor, you can systematically trace these webs. This method does more than just generate better ideas. It provides a massive head start in the research process. If you own a major railroad, you already have a deep understanding of its largest customers: utility companies burning coal, farmers shipping grain, manufacturers moving finished goods. When you decide to study one of those customer industries, you're not starting from zero. You already understand a huge component of their cost structure: transportation, from the carrier's perspective. You have a unique and valuable vantage point that an outside investor, drawn in by a headline, would lack. This process of adjacent exploration is a form of intellectual curiosity guided by a rational framework. It counteracts the brain's tendency to be swayed by whatever is most vivid and recent. It replaces the chaos of the news cycle with the ordered logic of the supply chain. It ensures that your journey of continuous learning is not a series of random walks in the dark, but a deliberate expansion from a brightly lit and well-fortified base of existing knowledge. This powerful mental model of adjacent exploration can be turned into a concrete, actionable blueprint for any investor seeking to grow their financial literacy. We can call this the industry supply chain map. It is a systematic process for generating new research ideas that are naturally connected to your existing circle of competence, turning the daunting task of learning about new things into a manageable and logical project. The first step is to take out a large sheet of paper or open a mind mapping software. In the very center, write the name of the company that you own and understand best. This is your anchor, your home base. It must be a business that you could confidently pass the 3 Whys test on. Step 2 is to begin mapping its immediate ecosystem. Draw a line out from your central company and create a box labeled Suppliers. Now, do the research. Who sells this company its essential raw materials, its software, its logistics services, its manufacturing equipment? List the names of these publicly traded supplier companies. You might need to read through the 10K annual report or listen to investor presentations to find this information. Step 3 is to draw another line from the center to a new box labeled Customers. Who are the primary buyers of your company's products or services? If your company is a component maker like Intel, its customers are computer manufacturers like Dell and HP. If it's a retailer like Costco, its customers are consumers, but you can think about its biggest product categories. Who makes the Kirkland signature products? Who are its biggest vendors? List these associated companies. Step 4 is to map the competitors. Draw a third line to a box and list the 1 or 2 most direct and formidable competitors to your central company. These are the businesses that keep your company's CEO awake at night. Now step back and look at your map. You have just transformed a single data point, one company you understand, into a rich web of interconnected research leads. Instead of facing the entire universe of thousands of stocks, you now have a curated list of perhaps 10 to 15 adjacent companies. Your mission is no longer the vague and overwhelming goal of getting smarter. It is specific and achievable. The final step is to choose your first reconnaissance mission. Pick just one company from your map. It could be a supplier, a customer, or a competitor. Your task for the next month is to acquire and read the most recent annual report, the 10K, for that single company. That's it. You are not trying to become a world expert overnight. You are simply taking one small, deliberate step outside your fortress walls to survey the immediate landscape. As you read, you will find your existing knowledge of your central company gives you an incredible advantage. When you read the competitors' report, you can compare their profit margins and growth strategies directly to what you already know. When you read the supplier's report, you will gain a deeper understanding of the input costs that affect your core holding. Each new piece of information reinforces and deepens your understanding of the entire system. After a month, you pick another company from the map, and then another. Over the course of a year, by following this simple, structured process, you will have moved from understanding one company to understanding the fundamental economics of an entire industry. You will have successfully and safely expanded your circle of competence, not through a risky leap of faith, but through a disciplined and manageable campaign of adjacent exploration. The alternative to this disciplined model is the chaotic and ultimately destructive approach taken by the vast majority of investors. This is the path of shiny object syndrome. The investor afflicted with this condition operates without an anchor. Their portfolio is not a reflection of deep knowledge, but a scrapbook of recent headlines and fleeting interests. One month, they are buying cannabis stocks because they read an article about legalization. The next month, they are selling those to buy into a SPAC for an electric vehicle company they heard about on social media. A few weeks later, they are dabbling in cryptocurrencies because their nephew made money on them. Their portfolio is a chaotic mess, a collection of 50 different stocks from 20 different industries, and they are an expert in none of them. This approach is doomed to fail for several reasons. First, it ensures that the investor is always a step behind. By the time an investment theme is popular enough to make front-page news, the big money has already been made. The FOMO, fear of missing out, that drives them to buy is a reliable signal that they are likely buying near a short-term top. Second, it creates a portfolio without a coherent strategy. There is no underlying logic, no unifying principle. It is simply a collection of impulsive bets. This makes it impossible to manage risk. The investor doesn't truly understand what they own, so they have no idea how these disparate assets will behave in a market downturn. They practice what Peter Lynch famously called diversification, the process of adding investments to a portfolio in such a way that the risk/return trade-off is worsened. They think they are diversified because they own many things, but in reality, they have just acquired multiple sources of unmanaged unknown risk. The psychological toll is immense. The investor is in a constant state of anxiety. They don't know why a stock is going up, so they don't know when to sell. They don't know why a stock is going down, so they don't know if it's a buying opportunity or a signal to panic. They are perpetually reacting to market noise, glued to their screen, their emotions rising and falling with every tick of the tape. This constant churn also generates enormous transaction costs and tax inefficiencies, a hidden drag that eats away at any potential returns. The shiny object syndrome investor is not really investing at all. They are playing a game of financial whack-a-mole. Their pursuit of personal growth and financial freedom is sabotaged by their lack of a disciplined framework for learning. They mistake activity for progress, and the inevitable result is a portfolio that dramatically underperforms a simple, boring index fund. It is the perfect illustration of how a failure to anchor your learning process leads directly to a portfolio adrift in a sea of randomness and fear. The strategic advantage of adjacent exploration, as opposed to random wandering, translates into a significant and quantifiable financial edge. This edge is found in the critical distinction between true diversification and the far more common diversification. True diversification, the kind that enhances portfolio development, is about owning a collection of assets whose primary business risks are uncorrelated. Owning both a consumer staples company and a high-end travel company is a form of diversification, because the economic forces that hurt one may not affect the other. However, the path of the 99%, buying a little bit of everything that's hot, is diversification. Owning a speculative biotech, a meme stock, and a cryptocurrency doesn't necessarily reduce risk if the primary driver of all their prices is the same thing: speculative market sentiment. When the risk-on mood evaporates, they can all collapse at the same time, regardless of their underlying businesses. Buffett's method of adjacent exploration creates a more intelligent and robust form of portfolio construction. Let's call it concentrated diversification. When he uses his knowledge of insurance companies to make an investment in a bank, he is adding a new business to his portfolio. On the surface, this is diversification. However, because both industries are in the financial sector, he has a deep understanding of the correlated risks they share, most notably their sensitivity to interest rate changes. He is not blindly adding a new source of risk. He is consciously taking on a new, but knowable, set of business dynamics. He understands both the unique aspects of the new business and how it fits into the broader economic picture he already has in his head. This allows him to build a concentrated portfolio of companies he understands at a granular level, which is a far safer approach than owning 100 companies you understand at a superficial level. This strategy manifests directly in a portfolio's risk-adjusted returns, a concept often measured by the Sharpe ratio. A higher Sharpe ratio indicates that a portfolio has generated better returns for the amount of risk it has taken. A portfolio built on the chaotic principles of shiny object syndrome will almost always have a low Sharpe ratio. It takes on enormous, uncompensated risk by investing in speculative assets it doesn't understand, and its returns are often eaten up by poor timing and transaction costs. A portfolio built through the patient expansion from a core of competence has a naturally higher Sharpe ratio. The deep understanding of each holding reduces the risk of permanent loss. The adjacent nature of the investments means the manager has a better grasp of the interconnected risks. The result is a portfolio that is less volatile and more resilient during market downturns. The direct financial connection is this: the quality of your learning process dictates the quality of your portfolio's risk management. Random learning leads to a portfolio of random risks. Structured, adjacent learning leads to a portfolio of understood and managed risks. One is a path to anxiety and underperformance. The other is the bedrock of long-term success and the steady compounding of wealth. Having a defined fortress of knowledge and a disciplined method for reconnaissance are the first two pillars. But the third pillar is where the real work is done, where casual interest is forged into true expertise. This is the full immersion doctrine. It's the commitment to move beyond surface-level understanding and achieve a state of deep fluency in a new subject. It's about recognizing that in the world of investing, a little knowledge can be a dangerous thing. To gain a true edge, you must go deeper than anyone else is willing to. This is the principle behind Warren Buffett's legendary reading habit, the often quoted 500 pages a day. It's not about speed reading headlines. It's about a methodical, all-consuming process of downloading a new industry into his brain until he understands its past, its present, and its most probable future. The acquisition of the BNSF Railway is a monumental example of this doctrine in practice. In 2009, in the depths of the financial crisis, Berkshire Hathaway made its largest acquisition ever, purchasing the Burlington Northern Santa Fe Railroad for a total investment of $44 billion. To the outside world, it might have seemed like a sudden, opportunistic bet on an old-world industry. But in reality, it was the culmination of a full immersion process that had been going on for years. Railroads were not traditionally seen as a great business. For much of the 20th century, they were capital-intensive, heavily regulated, and faced murderous competition from the trucking industry, which benefited from the government-funded interstate highway system. But Buffett had started watching. He wasn't just casually reading articles, he was engaged in a deep, systematic study. He devoured industry trade publications, historical books on the railroad barons, and, most importantly, the dense and detailed annual reports of every major railroad in North America for years on end. Through this immersion, he saw a story that others were missing. He saw that the industry had consolidated down to a few major players, creating regional duopolies. He understood that a railroad's tracks are a unique and irreplaceable asset. You simply cannot build another cross-country railroad. This gave them immense and durable pricing power. He analyzed the capital expenditure cycles and realized that after decades of underinvestment, the major railroads had finally upgraded their networks, making them more efficient than ever. Most critically, he looked at the long-term fundamentals and saw an undeniable tailwind. As fuel prices rose, the cost advantage of moving a ton of goods by rail versus by truck became enormous. A single train could move a ton of freight 500 miles on a single gallon of fuel. He recognized that railroads were the economic arteries of the nation, and as the population grew and the economy expanded, those arteries would become ever more valuable. This was not a superficial opinion. This was a deeply held conviction, built on a mountain of data. He understood the business from every angle: the competitive landscape, the regulatory environment, the labor relations, the unit economics. He had achieved true fluency. So when the financial crisis hit in late 2008, and stock prices plunged, he wasn't panicking. He saw opportunity. He knew the long-term value of BNSF was intact, even if the short-term economy was in turmoil. His deep knowledge gave him the courage to make a massive, all-in bet, while others were paralyzed by fear. The $44 billion acquisition was not a gamble. It was the logical and inevitable conclusion of his full immersion process. He had read so much for so long that he likely understood the long-term economics of the railroad business better than the executives running them. That is the edge that deep immersion provides. It transforms investing from a game of chance into a game of skill, where the person with the most comprehensive knowledge has a decisive and permanent advantage. The psychological principle that makes the full immersion doctrine so powerful is its ability to short-circuit a dangerous mental flaw: our deep-seated need to reduce cognitive dissonance. Cognitive dissonance is the mental discomfort experienced when holding two or more contradictory beliefs, ideas, or values. In investing, this occurs most often after a purchase. An investor makes a hasty, ill-researched buy. The stock immediately goes down. Now they are faced with two conflicting cognitions: I am a smart decision maker, and I just made a decision that resulted in a financial loss. This creates intense psychological discomfort. To resolve this dissonance, the brain's default path is not to admit the mistake, but to change one of the cognitions. The easiest one to change is the perception of the investment. The investor will begin to frantically seek out information that confirms their initial decision, a phenomenon known as confirmation bias. They will read only positive news articles, listen only to bullish analysts, and dismiss all negative information as noise or market manipulation. They are not trying to find the truth. They are trying to make themselves feel better about their past decision. Buffett's method of full immersion flips this entire process on its head. The intense, deep study happens before any significant capital is committed. His goal during the research phase is not to prove an idea right, but to actively try to prove it wrong. He is a hunter for disconfirming evidence. He reads the annual reports of the competitors specifically to understand the bear case. He studies the industry's history to learn about all the ways companies have failed in the past. He is conducting what psychologist Gary Klein calls a pre-mortem. He imagines the investment has failed spectacularly and asks, what went wrong? This rigorous, upfront process of attempting to kill the idea acts as a psychological vaccine against cognitive dissonance. By the time he decides to invest, his conviction is not a fragile hope. It is a battle-hardened conclusion that has survived a relentless intellectual assault. There is no dissonance to reduce because the decision is built on a comprehensive understanding of both the risks and the rewards. This is why he can act with such decisive conviction when markets are in turmoil. While the investor who is suffering from cognitive dissonance is paralyzed, afraid to sell and admit a mistake but also afraid to buy more, Buffett is free to act rationally. His deep knowledge base allows him to evaluate new information coolly and logically. When the price of BNSF stock fell during the crisis, he wasn't seeking confirmation that railroads were still good. He already knew that. The price drop was simply new information that told him his margin of safety had increased. He was able to separate the temporary sentiment of the market from the long-term reality of the business. The full immersion doctrine is therefore a powerful behavioral tool. It front-loads the intellectual and emotional work. It ensures that by the time you invest, your mind is clear, your conviction is solid, and you are immune to the psychological traps of confirmation bias and cognitive dissonance that destroy the returns of less prepared investors. To translate this doctrine into a practical, repeatable process, we can use a mental model called the 10K Gauntlet. This is a systematic guide to reading a company's annual report, the Form 10K, not as a compliance document, but as a deep and detailed business biography. This is how you move from being a headline reader to a true business analyst. The gauntlet has 5 key stages. First, start at the end. Before you read a single word of the narrative, go directly to the report of the independent registered public accounting firm, otherwise known as the auditor's report. Is it a clean or unqualified opinion? This means the auditor found no material misstatements. If there is any other kind of opinion, or if the auditor has changed recently, it is a massive red flag. This simple check can save you from wasting time on a company that may be cooking its books. Second, go back to the beginning, read the chairman's letter to shareholders. Pay less attention to the numbers and more to the tone. Does the CEO speak in clear, plain English, or is the letter filled with corporate jargon and buzzwords? Do they openly admit to mistakes and take responsibility, or do they blame poor results on external factors? A letter that is candid, humble, and focused on the long-term business is a good sign. A letter that is promotional and evasive is a warning. Third, get to the meat of the report. Read the business section and the risk factors section. After reading the business description, ask yourself, could I explain what this company does and how it makes money to a 10-year-old? If the answer is no, it's probably outside your circle of competence. Then, read the risk factors not as boilerplate legal language, but as a roadmap of what could go wrong. Do these risks seem plausible? Do they seem manageable? This is where the company is forced to tell you why you shouldn't invest. You should listen carefully. Fourth, analyze the numbers. This means looking at the 3 core financial statements, the income statement, the balance sheet, and the cash flow statement, for at least the last 5 years. Don't just look at the most recent year. You are looking for trends. Is revenue growing consistently? Are profit margins stable or expanding? Is the company taking on more and more debt? Most importantly, how does the reported net income compare to the actual cash from operations? A company that consistently reports high profits but generates little cash is a major red flag. Finally, and most critically, you must read the fine print. Dive into the footnotes to the financial statements. This is where the complexity lies, and it's where companies often hide problematic information. You need to look for details on pension obligations, off-balance sheet entities, legal proceedings, and how they recognize revenue. This is the most difficult part of the process, but it is also the most valuable. The gauntlet isn't complete until you have done this for not just your target company, but for its top 2 competitors as well. Only by comparing the numbers and the language side by side can you gain the context necessary to truly understand the business. This process is not easy. It is time-consuming and requires intense focus, but it is the only way to achieve the deep fluency that separates professional investors from amateurs. It is the price of admission to a higher level of investor education. The antithesis of the 10K gauntlet is the headline and PE analyst. This is the approach used by the overwhelming majority of market participants. Their entire research process consists of 2 data points. First, they see a compelling headline or hear a good story. Company X is a leader in the artificial intelligence revolution. This grabs their emotional attention. Second, they look up the stock's price-to-earnings (PE) ratio and perhaps compare it to its competitors. If the PE seems reasonable, they conclude the stock is a good investment and they buy it. This is the financial equivalent of deciding to marry someone based on their dating profile picture and their job title. It is a decision of staggering superficiality. The headline and PE analyst has no real understanding of the business they now own. They have no idea about the company's debt load, which could be a ticking time bomb. They don't know its return on invested capital, the true measure of its profitability. They haven't assessed the quality and integrity of its management team. They have no nuanced view of the competitive landscape. They have simply purchased a ticker symbol attached to a story they like. This approach leaves them completely vulnerable. When the company reports a bad quarter, they have no context. They don't know if it's a temporary hiccup or the beginning of a long-term decline. When a competitor launches a new product, they have no way of knowing if it poses a genuine threat. A classic example of a company that looked good to the headline and PE analyst for years was General Electric. For a long time, GE was a blue-chip stock, a member of the Dow Jones Industrial Average, with a reputation for consistent earnings growth. On the surface, the numbers looked fine. The PE ratio was often reasonable. The story was compelling. A diversified industrial giant with a hand in everything from jet engines to medical devices. But anyone who put GE through the 10K gauntlet would have discovered a rotten core. They would have seen an immense and complex financial division, GE Capital, that was essentially a black box of risky loans and derivatives. They would have seen that the consistent earnings were often the product of aggressive accounting manipulations, not underlying business strength. They would have discovered massive, unfunded pension liabilities hidden in the footnotes. When the 2008 financial crisis hit, this house of cards collapsed. The stock price was decimated, the dividend was slashed, and the company was broken apart. The headline and PE analysts were wiped out, left wondering what happened. The investors who had done the deep immersion work were not surprised. They had seen the cracks in the foundation years earlier. The path of the 99% is a shortcut that leads off a cliff. It prioritizes ease and speed over depth and rigor, a trade-off that, in investing, always ends in disaster. The ultimate financial advantage of the full immersion doctrine comes from its ability to differentiate between the superficial appearance of profitability and its underlying reality. This is captured in the focus on a metric called return on invested capital, ROIC, versus the more commonly cited earnings per share, EPS. The headline analyst lives and dies by EPS. It's the number that flashes across the screen on financial news channels. A company beats on earnings, and the stock pops. It misses on earnings, and the stock drops. But EPS can be dangerously misleading. It can be easily manipulated through accounting gimmicks, such as changing depreciation schedules or recognizing revenue prematurely. More commonly, it can be inflated through share buybacks. A company can increase its EPS simply by reducing the number of shares outstanding, even if the underlying business isn't growing at all. The deep immersion expert, who has gone through the 10K gauntlet, understands that the true driver of long-term value is not the amount of earnings, but the quality and efficiency of those earnings. This is measured by ROIC. The calculation is simple in concept. You take the company's net operating profit after tax and divide it by the total capital invested in the business, both debt and equity. The result tells you how much profit the company generates for every dollar of capital it employs. This single number reveals the fundamental economic engine of the business. A business that consistently generates an ROIC of 20% is a magnificent compounding machine. It can reinvest its profits back into the business and earn high rates of return, creating a virtuous cycle of value creation. A business with an ROIC of 5% below its cost of capital is a capital furnace. The more it grows, the more value it destroys. Only by performing a deep dive into the financial statements can an investor truly calculate and understand a company's ROIC. You need to analyze the balance sheet to determine the true amount of capital invested. You need to comb through the income statement and footnotes to find the real, sustainable operating profit stripped of any accounting shenanigans. This focus on the efficiency of capital is the direct financial connection that separates a Buffett-style investor from the rest. It's the difference between buying a business that is a beautiful, self-funding growth engine and buying one that looks good on the surface but constantly requires more and more capital just to stay in the game. Over the long term, a portfolio of high ROIC businesses will dramatically outperform a portfolio of businesses bought simply because they had a low PE ratio or a good story. This superior performance is the direct and quantifiable reward for choosing the difficult path of full immersion. You have defined your fortress. You have conducted your reconnaissance. You have completed your full immersion and believe you have achieved fluency in a new industry. The temptation now is to act decisively, to make a large bet. But this is where the fourth pillar comes into play, a crucial step that introduces a firewall of patience and real-world testing between knowledge and large-scale action. This is the test deployment phase. It's about recognizing that even after exhaustive research, your knowledge is still theoretical. It has not yet been tested against the harsh and unpredictable reality of the market. This pillar is about making small, calculated bets and allowing time and evidence to validate your thesis before you commit significant capital. It is the bridge between intellectual conviction and financial execution. The story of Warren Buffett's journey with Apple is a masterclass in the patient power of test deployment. For decades, Warren Buffett famously and publicly avoided technology stocks. His reasoning was simple and consistent. They were outside his circle of competence. The pace of change was too fast, the threat of obsolescence was too high, and he felt he had no edge in predicting which companies would dominate in the long run. He watched as companies like Microsoft and Intel created immense wealth, and he was comfortable missing out. But while he wasn't buying, he was observing. He was engaged in a long, slow period of vicarious learning. He saw the rise of the internet, the dot-com bust, and the emergence of a new generation of tech giants. He wasn't studying them as a technologist trying to understand code or microchips. He was studying them as a student of business models and consumer behavior. His lens began to shift with the iPhone. He saw the device not just as a piece of hardware, but as the center of a powerful and sticky ecosystem. He saw friends and family who would never dream of switching to another phone because their photos, their music, their apps, and their digital lives were all locked into the Apple ecosystem. This was a language he understood. This looked less like a rapidly changing technology company and more like a dominant consumer brand with a massive, unbreachable moat, similar to American Express or Coca-Cola. Still, he hesitated. The idea was forming, but the full immersion wasn't complete. He began to talk extensively with his two younger investment deputies, Todd Combs and Ted Weschler, who had a deeper background in technology. They were his on-the-ground reconnaissance team. They provided him with a different perspective, helping him get comfortable with the industry's dynamics. Sometime in 2016, one of them, likely Todd or Ted, made an initial investment in Apple for Berkshire Hathaway. It was a relatively small purchase, about $1 billion. For Berkshire, this was a toe in the water. It was a test deployment. It put the company on their radar in an official way. It forced them to follow the quarterly earnings calls with an owner's mindset. Buffett could now watch the company's performance not as a casual observer, but as a shareholder. He could see if the thesis about the ecosystem's stickiness and pricing power was bearing out in the real-world numbers. And what he saw confirmed and strengthened his conviction. He saw iPhone users, incredible loyalty, the growth of the high-margin services business, and Tim Cook's brilliant capital allocation strategy of returning massive amounts of cash to shareholders through buybacks. The test was a resounding success. Only then, after years of observation and a successful initial deployment, did Buffett open the floodgates. Berkshire began buying Apple stock hand over fist, accumulating a position that would eventually be worth over $100 billion, becoming the single largest common stock holding in their portfolio. The initial purchase wasn't the final decision, it was the final experiment. It was the patient, deliberate step that allowed him to turn decades of passive learning into one of the most successful investments in financial history. This deliberate, patient approach is a powerful defense against two of the most potent and destructive cognitive biases in finance: the endowment effect and loss aversion. The endowment effect, first described by economist Richard Thaler, is our tendency to irrationally overvalue something simply because we own it. An old coffee mug that you wouldn't pay more than $1 for suddenly becomes a precious $5 keepsake the moment it becomes Combs or coffee mug. Loss aversion, a cornerstone of prospect theory from psychologists Daniel Kahneman and Amos Tversky, describes the fact that for most humans, the pain of a loss is about twice as powerful as the pleasure of an equivalent gain. Losing $100 hurts far more than finding $100 feels good. When an investor makes a large all-in investment right from the start, they immediately trigger this toxic psychological cocktail. The moment they buy the stock, the endowment effect kicks in. It's no longer just a stock, it's my time stock. They become emotionally attached. Then, if the stock price drops even slightly, the intense pain of loss aversion is activated. This combination is paralyzing. They are trapped. The endowment effect makes it difficult to sell and admit a mistake because they are psychologically anchored to a higher valuation. Loss aversion makes the prospect of realizing the loss feel so painful that they will often freeze, doing nothing, hoping the stock will recover so they can just get back to even. This emotional state is the enemy of rational decision-making. Buffett's method of watching for years and then making a small initial test deployment is a brilliant way to keep these biases at bay. During the long observation period, he has no ownership, so the endowment effect is not a factor. He can analyze the business coolly and objectively. The small initial purchase is the key. Because the position is small relative to the total portfolio, any initial drop in price does not trigger overwhelming loss aversion. It's a manageable loss, an acceptable cost of gathering information. It doesn't create panic. This small stake allows him to get skin in the game and experience the company as an owner, but without the emotional baggage that comes with a large position. He can watch the stock's volatility, observe how management communicates during earnings calls, and see how the business performs over several quarters. He is gathering real-world data without being emotionally compromised. He only scales up his investment after his thesis has been validated by both his research and the company's actual performance. By then, his conviction is so high that it can override the emotional noise of short-term market fluctuations. The test deployment phase is a behavioral finance masterstroke. It's a quarantine period that separates your initial idea from your emotional biases, ensuring that the final decision to commit major capital is driven by logic and evidence, not by ego and fear. We can operationalize this principle into a clear, two-part mental model for any investor to use: the paper portfolio and the tripwire. This blueprint creates a structured, patient process for moving from research to real-world investment, building in the necessary firewalls to protect against emotional decision-making. Part 1 is the paper portfolio. Before you invest a single real dollar in a new industry or company you've been studying, you must first create a paper portfolio. This is your investment flight simulator. In a simple spreadsheet or a dedicated portfolio tracking app, you will buy a selection of 3 to 5 companies in the new sector you believe you understand. For each one, you must write down a clear, one-paragraph thesis explaining why you are buying it. You must also record the date and the price. Then, for a minimum of 6 months, you will track this paper portfolio as if it were real money. You will read the quarterly reports as they are released. You will follow the news affecting the industry. At the end of each quarter, you will review your initial thesis for each company. Was it correct? Did the company's results support or contradict your expectations? This process costs you nothing but time. Yet the value is immense. You get to experience the volatility and the news flow of the industry without the emotional turmoil of having real money on the line. You will learn how the stocks behave, and you will get an honest assessment of how good your initial analysis really was. It allows you to make your rookie mistakes for free. Part 2 is the tripwire. If, after at least 6 months of paper trading, your thesis has proven to be largely correct and you are ready to commit real capital, you do not go all in. You use a tripwire. A tripwire is a small, predetermined amount of capital that you will use for your initial test deployment. This amount should be meaningful enough that you will pay close attention, but small enough that a 50% loss would not significantly impact your overall portfolio's value. For most people, this might be 0.5% or 1% of their total investable assets. You make this initial purchase, and then you set a crucial rule for yourself. You are programmatically forbidden from adding to this position until at least 2 full quarterly earnings reports have been released since your initial buy. This rule forces a period of at least 6 months of real money ownership before you can escalate your commitment. It prevents you from getting swept up in initial excitement and buying more just because the stock went up a little. It forces you to sit and watch how the business actually performs, to listen to how management communicates, and to see if your thesis continues to hold up under the added pressure of real ownership. The paper portfolio and the tripwire system imposes the patience that our emotional brains lack. It creates a structured, evidence-based path from idea to full position, ensuring that by the time you make a significant investment, it is the result of a long and disciplined campaign, not an impulsive act of financial courage. To see the devastating consequences of skipping this crucial phase, we need only look at the FOMO all-in gambler. This is the investor who is driven entirely by the fear of missing out. They hear a hot tip from a friend, see a stock being hyped on a forum like Reddit's Wall Street Bets, or watch a company's price skyrocket day after day. This triggers a powerful emotional response. They don't see a business to be analyzed. They see a rocket ship leaving without them. Their research process is a frantic, 15-minute Google search. They don't build a paper portfolio or set a tripwire. They take a huge portion of their capital, sometimes even using leverage or options to magnify their bet, and they throw it all at the stock in a single transaction, often after it has already run up dramatically. Their entry point is not based on a calculated assessment of value, but on a peak of social mania. They are buying at the moment of maximum excitement and, often, maximum risk. A horrifying, large-scale example of this mentality was the 2021 implosion of Archegos Capital Management. Archegos was a private family office that used massive amounts of leverage borrowed from major investment banks to make gigantic, concentrated bets on a handful of stocks. They didn't scale in patiently. They went all in, using complex derivatives called total return swaps to build positions that were many times larger than their actual capital. For a while, as their chosen stocks went up, they made billions. But they had skipped the test deployment. They had no margin for error. When 1 or 2 of their stocks began to fall, their prime brokers issued a margin call, demanding more capital. Archegos didn't have it. This forced the banks to start liquidating the massive positions, causing the stock prices to plummet further, which triggered more margin calls in a catastrophic downward spiral. In the span of a few days, a fortune estimated at over $20 billion was completely annihilated. It was one of the fastest and most spectacular wealth destructions in modern history. While few individuals operate on that scale, the underlying psychology is the same. The FOMO all-in gambler who buys GameStop at $400 because of a Reddit post, the person who plows their savings into a cryptocurrency at the peak of a bull run, the day trader who goes all in on a pharmaceutical stock on a rumor of a new drug, they are all mini archegos. They have skipped the crucial steps of deep research and patient deployment. They have mistaken a gamble for an investment. Their actions are not governed by a process of intellectual curiosity and risk management, but by the raw, powerful emotions of greed and fear. This path almost always ends in the same way: a catastrophic loss that not only wipes out capital, but also shatters the investor's confidence, sometimes so badly that they abandon the market forever. The financial mechanics of a patient, multi-step deployment strategy create a distinct and measurable advantage over the all-in gamble. This advantage is crystallized in the difference between a disciplined form of dollar-cost averaging and the terrifying act of, quote, catching a falling knife. When an investor uses the tripwire model, they are essentially setting themselves up to scale into a position over time. After their initial small purchase, they have a clear plan. They will wait for more evidence from the company's performance. If their thesis is confirmed and the stock price has gone up, they can add to their position with increased confidence. More powerfully, if their long-term thesis remains intact, but the market has a temporary panic and the stock price drops, this is not a disaster, it's an opportunity. They can now add to their position at an even lower price, improving their overall cost basis. This is a strategic, informed application of dollar-cost averaging. They are not blindly buying more. They are buying more because their deep research gives them the conviction that the market is wrong. Now consider the FOMO all-in gambler. They buy their entire position at a single price point, often near the peak. When the stock inevitably falls, they are faced with a nightmare scenario. They are sitting on a large, unrealized loss. The emotional pain of loss aversion is screaming in their head. They have two choices. They can sell and lock in a devastating loss, or they can buy more to, quote, average down. But this is not the strategic dollar-cost averaging of the prepared investor. This is a desperate act known as catching a falling knife. They have no deep research to fall back on. Their initial conviction was based on hype, not fundamentals. So, buying more is not a rational act based on an assessment of intrinsic value. It is a panicked gamble to try and make their pain go away. They are throwing good money after bad, compounding their initial mistake. The direct financial connection is clear and brutal. The patient investor who scales into a position achieves a lower average purchase price over time and dramatically reduces their risk. By waiting for more information before committing more capital, they protect themselves from being overexposed to a flawed thesis. Their financial journey is one of controlled risk and increasing conviction. The gambler who goes all in and is forced to consider catching a falling knife is on a path of escalating risk and deteriorating emotional control. Their financial journey is a volatile lurch towards a high probability of catastrophic loss. One strategy is designed to build wealth methodically. The other is a blueprint for destroying it. The choice between them is the choice between patience and impulse, and the financial outcomes could not be more different. We have arrived at the final pillar, the culmination of the entire process. After defining your fortress, conducting reconnaissance, achieving full immersion, and successfully navigating a test deployment, you reach the moment of truth. This is the stage where you officially redraw the map of your own competence. This is where a once foreign and intimidating territory is formally annexed and integrated into your sovereign domain of knowledge. This pillar is about understanding the signs of true mastery, the point at which a new area is no longer a subject of study, but a core tenet of your investment philosophy. It is the ultimate goal of continuous learning, the successful and permanent expansion of your circle. The evolution of Warren Buffett's thinking from a classic brand investor in Coca-Cola to the largest single shareholder in Apple is the definitive story of a redrawn map. For decades, the bedrock of Buffett's expanded circle of competence was his understanding of the durable competitive advantages, or moats, of great consumer brands. His 1988 investment in Coca-Cola was the quintessential example. He understood that Coca-Cola wasn't just a beverage company, it was the owner of a piece of real estate in the minds of billions of people around the globe. That mental space, built by a century of advertising and consistent product quality, gave Coca-Cola incredible pricing power and global reach. He could explain the business simply. They sell a cheap-to-produce syrup concentrate to bottlers all over the world, who then do the heavy lifting of mixing, bottling, and distributing the final product. It was a capital-light, high-margin, predictable business. This model, a powerful brand creating a durable moat, became the blueprint for many of his greatest investments. All the while, he viewed the technology sector as a completely different continent, one with rules he didn't understand. He saw it as a world of brutal competition, short product cycles, and companies whose moats could evaporate overnight with a single innovation from a competitor in a garage. He couldn't explain how a semiconductor company worked in simple terms. He couldn't confidently predict what the enterprise software landscape would look like in 10 years. So he stayed away. His map had a clear boundary, and technology was firmly on the other side. But as he observed Apple over the years, as he went through his long process of learning and test deployment, he had a profound realization. The map he had been using was outdated. The world had changed, and the nature of technology itself had evolved. He finally saw that Apple, under Tim Cook, was no longer a classic technology hardware company. It had transformed into something he understood perfectly. The iPhone was not just a phone, it was the new Coca-Cola. The brand's power created a fierce loyalty that allowed Apple to command premium prices. The ecosystem of apps, music, and services created immense switching costs, a modern-day moat as powerful as any he had ever seen. He realized he didn't need to understand the intricate details of the A15 Bionic chip to understand Apple's business model. He just needed to understand the psychology of the consumer and the power of the ecosystem. He could explain the investment thesis with the same simplicity as Coca-Cola. Apple sells high-margin hardware that locks customers into a high-margin recurring revenue services ecosystem. He had discovered that the fundamental principle he had mastered 30 years prior with Coca-Cola was now applicable in a territory he had previously marked as, quote, unknown. Apple wasn't a venture into a new world. It was the discovery that his old world was much larger than he thought. In that moment of insight, he redrew the map. The circle of competence wasn't broken. It was expanded. A vast, wealthy, and once intimidating continent was now integrated into his empire, leading to one of the most profitable investments of his entire career. This ability to redraw one's mental map is a direct assault on a powerful and crippling cognitive bias, the Einstellung effect. The word Einstellung is German for mindset or attitude. In psychology, it refers to a person's predisposition to solve a given problem in a specific manner, even though better or more appropriate methods exist. It's the tendency to get stuck in a rut, to use a familiar tool even when it's the wrong one for the job. It's the mental trap of, "That's the way I've always done it." For years, Buffett's mindset, "Tech is a bad industry for value investors," was a useful and protective heuristic. It saved him from the dot-com bust, but as the industry matured, that same mindset became a barrier, a form of cognitive rigidity, that prevented him from seeing the opportunity in Apple clearly. The Einstellung effect is the great danger of a static circle of competence. It can cause you to become so entrenched in your existing expertise that you become blind to how the world is changing around you. The process of disciplined expansion we've been discussing is a deliberate and continuous fight against this mental trap. It requires a rare and powerful trait: intellectual humility. It's the ability to question your own long-held beliefs. It's the courage to say, "My old map of the world might be wrong. A principle I know and trust might now apply in a place I have always dismissed." Most people are incapable of this. Their ego becomes intertwined with their expertise. To admit their map is outdated feels like a personal failure. So they cling to their old knowledge, defending it fiercely even as it becomes obsolete. They become masters of a shrinking and irrelevant domain. Redrawing the map is the final victory over the Einstellung effect. It is the moment when you successfully update your brain's operating system. It requires you to separate your principles from their past applications. Buffett's principle was always about finding businesses with durable competitive moats. For a long time, he only found them in companies like Coca-Cola or See's Candies. His breakthrough was realizing that the principle could be applied to a new type of company, Apple. The principle remained the same. The application evolved. The journey of expanding your circle of competence is therefore not just a journey of learning new things. It is also a journey of unlearning old, outdated mindsets. It is the active, lifelong process of challenging your own assumptions, embracing intellectual humility, and having the courage to redraw the maps that guide your decisions. How then do you know when you have truly achieved this level of mastery? How can you be certain that you are not deluding yourself, and that a new territory is officially and safely part of your circle? There are two final tests, a mental model we can call the inversion test and the simplicity mandate. First is the inversion test. This technique, championed by Buffett's partner Charlie Munger, comes from the mathematician Carl Jacobi, who believed in, quote, inverting, always inverting. Instead of asking how to achieve a goal, you ask how you might fail to achieve it. In investing, instead of asking, what are all the reasons this investment will succeed, you must force yourself to ask the opposite. What are all the ways this investment could go horribly wrong and lead to a permanent loss of capital? Your task is to write down at least 10 specific, plausible, business-related points of failure. Vague fears like the stock market might crash or there could be a recession don't count. The reasons must be specific to the company. For example, for a retailer it might be, a change in consumer tastes could make their brand unfashionable, or a new, aggressive online competitor could permanently destroy their profit margins. If you can easily list and analyze 10 or more specific threats, it demonstrates a deep and nuanced understanding of the business and its risks. If you struggle to come up with anything beyond generic market fears, it is a sign that your knowledge is still superficial. You don't understand the business well enough to know how it could die. Second is the simplicity mandate. This is Buffett's own famous test. Could you explain the investment thesis on the back of a napkin, in simple, clear language, to someone who is not an expert in business or finance? Could you make your spouse or your grandmother understand not just what the company does, but why it is a durably profitable enterprise? If you find yourself resorting to complex industry jargon, acronyms, and convoluted explanations, it's a warning sign. True mastery, true competence, is the ability to distill complexity into profound simplicity. As Albert Einstein reportedly said, if you can't explain it simply, you don't understand it well enough. When you can clearly articulate both all the ways an investment can fail, the inversion test, and explain its core thesis in a single simple paragraph, the simplicity mandate, then and only then have you earned the right to say you have redrawn your map. You have not just learned about a company, you have achieved a state of deep, functional, and reliable competence. The failure to complete this final step leads to two equally disastrous outcomes, two antithetical paths to ruin. The first is the permanent specialist. This is the investor who correctly defines their circle of competence but then fails to ever expand it. Their knowledge becomes a prison. They are the investor who mastered the economics of newspaper monopolies in 1980. It was a brilliant and profitable skill for a time, but they refused to learn anything else. They dismissed the internet, they ignored the shift in advertising, they clung to their old expertise. They rode the newspaper industry all the way to its near extinction. Their circle of competence, once a fortress, became a tomb. Their refusal to engage in the process of continuous learning made them a fossil, and their portfolio suffered a slow, grinding death. The second path to ruin is that of the delusional dabbler. This is the investor who is eager to expand their circle but lacks the discipline and rigor we have discussed. They read one popular science article about genomics and declare themselves a biotech investor. They watch a YouTube video about blockchain and start redrawing their map to include decentralized finance. They mistake a fleeting familiarity with a topic for genuine competence. They redraw their map not with the indelible ink of deep research, but with the crayon of wishful thinking. They pass neither the inversion test nor the simplicity mandate. They cannot articulate the specific risks, and their explanation of the business is a jumble of buzzwords they barely understand. Their expanded circle is an illusion, a dangerous self-deception that gives them the confidence to make large bets in areas where they are, in reality, complete novices. Their portfolio becomes a minefield of unmanaged risks, and the inevitable explosion is just a matter of time. Both the permanent specialist and the delusional dabbler fail. One perishes from stagnation, the other from hubris. The only path to long-term success is the disciplined middle way, the slow, patient, and rigorous expansion of genuine knowledge, a circle whose growth is earned, not merely declared. This brings us to the ultimate direct financial connection, the point where this entire philosophy of learning translates into the compounding of wealth. The rate at which your knowledge grows over your lifetime places a hard speed limit on the rate at which your capital can sustainably compound. They are inextricably linked. Think of the permanent specialist. As their area of expertise, newspapers, let's say, becomes technologically obsolete, their investment universe shrinks. There are fewer and fewer high-quality opportunities for them to deploy their capital. Eventually, their universe shrinks to zero. Their knowledge has stopped compounding, and as a direct result, their capital will inevitably follow suit, either through losses in their dying industry or by being forced into cash, earning nothing. Their financial growth hits a wall because their intellectual growth hit a wall years earlier. Now consider the delusional dabbler. Their enthusiastic but undisciplined expansion leads them to make catastrophic mistakes. They might have one lucky win, but their frequent, large losses in areas they don't understand act as a massive anchor on their portfolio. Compounding requires a steady, consistent positive return. A single 50% loss requires a 100% gain just to get back to even. The delusional dabbler's portfolio is a story of one step forward, two steps back. The massive losses from their ill-advised ventures outside their true circle destroy the very engine of compounding. The disciplined expansion of your circle of competence is the only way to solve both problems. As you successfully and rigorously add a new industry to your domain, moving from consumer brands to railroads or from insurance to banking, you are expanding your opportunity set. You are creating more potential homes for your capital. This allows you to be more selective, to only invest in the absolute best ideas that you come across in your ever-widening field of vision. The compounding of your knowledge, the lattice work of mental models in your head growing richer and more interconnected each year, is what fuels the compounding of your capital. The more you know, the more you see. The more you see, the better decisions you make. The better decisions you make, the faster your wealth grows. This is the final promise. The hard work of reading, of studying, of patiently testing your ideas is not just an intellectual exercise. It is the direct and primary driver of your long-term financial success. The size and strength of your financial fortress 10, 20, or 30 years from now will be a direct reflection of the commitment you make today to the continuous and disciplined expansion of the fortress in your mind. You have made it to the end of this deep analysis, and in doing so, you have invested something far more valuable than money. You have invested your time and your attention. That investment has armed you with a powerful and complete mental model, a 5-pillar framework not just for understanding Warren Buffett's Circle of Competence, but for building and expanding your own. You now possess the blueprint for creating a fortress of knowledge, a system for intelligent exploration, a doctrine for deep immersion, a strategy for patient deployment, and a mandate for redrawing your own map of expertise. This is more than just an investment strategy. It is a system for continuous learning and self-improvement that can transform how you make decisions in every area of your life. But it is crucial to understand that Buffett's success is not the result of a single model, but a network of interconnected mental models that support and reinforce one another. The system you have just mastered, the disciplined expansion of your circle of competence, is a single, foundational piece of a much larger intellectual machine. It is one crucial node in a complex latticework of thought that governs how he approaches risk, values businesses, and manages his own psychology. Mastering this one piece gives you a tremendous advantage, but it also reveals a strategic knowledge gap. How does this model of learning connect with his methods for calculating intrinsic value? How does it intersect with his philosophy on market psychology and exploiting the irrationality of others? The video that is now appearing on your screen is not an accident. It has been selected because it contains the next piece of the map. It is the link that connects the pillar of knowledge you just built to the next one in the architecture of wealth. Think of what you've learned today as mastering the rules of the individual pieces on a chessboard. The video on your screen is about to teach you the grand strategy of the game itself. Clicking to watch it is not just about starting another video. It is a conscious decision to continue your ascent, to add the next layer to your mental arsenal. The casual viewer stops here, satisfied with a single piece of the puzzle. But those who are truly committed to the journey of becoming a more formidable thinker and a more successful investor understand that the real power lies in completing the full picture. The choice is yours. Are you here for a single lesson, or are you here to master the entire system? If you are ready for the next stage, the missing link awaits.